Welcome to our Day 1 revision exercise for Principles of Accounts June 2026 students. Now, I have given most students who have signed up early a revision checklist. For each day, we have set out what you comfortable in, what is your confidence level, what is your strength, and what is your weaknesses. So this is for you to do. This is for you to test yourself, that only you can analyze yourself. As you go through the topics, find what you did wrong, why it was wrong. This is the only way you can correct where you are going wrong. Now we're at the critical stage for this exam. So we're going to focus on exam type paper questions so that you'll know how the examiners come, what they expect of you. Okay? So day 1, we look at financial statements and adjustments, which as advertised. You will click your confidence level. You put what is your strength and what is your weaknesses based on your assessment. Day 2, we'll do some controls accounts like your sales ledger and purchases ledger. Incomplete records on day 3. Day 4, errors and suspense account. Day 5, bank reconciliation. Day 6, depreciation and disposals. And day 7, we may look at exam strategies, or I may include partnership as a topic into this day 7. Now, diving right into day 1, in an effort to save time, what we will be looking at is June 2019 paper 2, which is a heavy adjustment question, and CSEC POA 2017, which is dealt with provision for doubtful debts. Now, before we go into this, I want to ensure that you all remember what your financial statements look like. So your income statement, this is a full income statement here, as you can see. It has from all the little accounts that need to minus, all the accounts that you have to add on, how you arrive at your gross profit and your net profit. This you should have known by now. However, if you don't know, take a copy of it, ensure that you know the format of these financial statements. It is critical that you know the format and how to input the information. As we address the question that we have for day 1, you will see how important it is that you know where your information falls into in your statement of financial position. Now, we have income, sales, or revenue. Then you less your sales return to get your actual sales for the period of time. However, I want students to ensure that they knows how to calculate your cost of goods sold. Cost of goods sold has a formula. Most students don't recognize what they're doing here is working out their cost of goods sold. So in order to find that, you have opening inventory, add your purchases and your carriage inwards. Now the second column here is where we use to do the working, and you put your totals here, right? This is what I just want to mention, that one student asked me, why do we have all these columns? Instead of having everything jumbled up under one column coming down, you have working columns where you can actually work out some of the figures and take that subtotal into your total columns. So open inventory, add purchases, add your carriage inwards, less your purchases return, and your closing inventory gives you your cost of goods sold. From your cost of goods sold, you minus it from your sales, which will give you your gross profit. Make sure you highlight these items in your income statement for the examiner to know that you knows what you are calculating. Now, most questions may not have this, but just in case, you have to be exam ready. Discount received and interest received is added to your gross profit to recognize that, like an increase in income is not a normal revenue or income. I see some lecturers put it all the way up here. However, it's not the correct method to put it all the way up here by your sales, because sales less cost of goods sold actually gives you your gross profit on the sales. By inserting it into your income, it distorts your gross profit figure. So what you really have to do is supposed to include it after gross profit. So discount received and interest received, you include it after gross profit. And your reduction in provision for doubtful debts, you add that as well. Then you less expenses or overhead costs. These are basic expenses. You should know most of the expenses and be familiar with it already. Like wages and salary, rents and rate, electricity, discount allowed, depreciation, carriage outward, bad debts written off, and increase in provision for doubtful debts. All of these are expenses, overhead costs. You minus your total expenses from your your profit, and you get a net profit. This is your income statement. Please ensure that you know your income statement. Your statement of financial position, however, same format. All of your assets less your liabilities gives you a capital. Now, your asset is categorized by non-current asset. You have a cost column, accumulated depreciation, and net book value. Your asset is listed in order of permanence unless the examiners ask you to do it in accordance to liquidity, which means to say you will have the reverse of how you list it here. So in order of permanence is that the one that has a longer lifespan will be to the top and the less lifespan will be underneath to the least to the last one. Same thing as current asset. Your current assets is the same way as listed. However, in this case, I included your accounts receivable and less your provision for doubtful debt so that you can have a subtotal to put under your current assets as you work and come down the line. Don't forget your prepaid expenses. Most students include minus the prepayments from their income statement and forget to include it as a current asset in their statement of financial position. So please do not forget your prepaid expenses or your accrued expenses as a liability. Now, one thing in your financial statement, you must also remember current asset minus your current liabilities will give you working capital, which is also called your net current asset. Please highlight that. So it's your net current assets. Remember the accounting formula, assets minus liabilities gives you a capital. So after you get your net current asset, you add all of your assets together and you minus your non-current liabilities, which will give you a net asset, which is also your capital. So your net asset should be equal to your capital. And you know how to find your capital for a sole trader. Finance by its capital, add net profit. Or less your loss, less drawings will give you your capital. So that is to review your financial statement. Please ensure that you know this, that you practice question. And even so, if you don't practice question, practice writing this over and over so that you'll know the format and what goes and where it goes, right? Another thing I want to look at is that the adjusting entries that you must remember to address is your prepayments, accruals, and depreciation, bad debts, and provision for doubtful debts. Now, how does this affect your financial statement? Prepayments, it reduces expenses, so therefore it increases your profit in your income statement. But it also increases your current asset because students forgot once again to put your prepayments in your balance sheet, which is your statement of financial position. Accruals, it increases your expenses, so it reduces your profit and also increases your current liability in your statement of financial position. Depreciation increases your expenses or reduces your profit, which also reduces your non-current asset. Now, depreciation is not minus straight from the cost of the asset, but it's a balancing figure in your financial statement to show the reduction or your net book value. Bad debts is written off immediately from your accounts receivable or your age receivable. So therefore, it has no other effect once it is written off. It is already written off. You don't have to apply it again in your statement of financial position, but it must increase your expense or reduce your profit. Unless the examiner says no adjustments were made for the bad debts, then you now have to credit your age receivable and debit your income statement. Provision for bad debts, you have to increase or decrease your expenses according to if the adjustment for the year, according to the adjustment of the year, if it's an increase or decrease in the provisions. So when you do practice questions on provision for doubtful debts, you should look at that to know whether it is an increase or decrease. Because as we look at the income statement, you would see you have reduction in provision for doubtful debts has to be added to your gross profit, but an increase in the provision for doubtful debts is an expense in your total expenses, right, which reduces your net profit. So accordingly, it will affect your profit according to whether it's an increase or if it is a decrease. So much for the recap and what we're going to look at. This question, day one question, looks at statement of financial position. However, the examiner strategy towards this question was really tactical. It was really a good strategy because as students look at this question, the first thing you think about a financial position, state a balance sheet, but shouldn't we have been gotten a trial balance? What are we going to do? So the first thing when you read this question, as I tell students, read the requirements first. Always read your requirements first. Know what the examiner is asking of you. Know what they want so that you will know what to start working with. So using all the information provided above, prepare a classified statement of financial position, balance sheet for Simon Cook in vertical style as at the 31st of January 2018. Use the order of permanence. So you see the examiner asks you to use the order of permanence in classifying the asset. Show your working capacity clearly and round off all your workings to the nearest whole number. So they want you to round it off. So I tell students, when you're looking at this question, it's a 20-mark question, so you'll have to take about 36 minutes to do this question, right? How are you going to decipher this, read this, and put it in the statement of financial position? Save yourself some time and get the question correct. Your approach should be is to first take the information and put it into a familiar ground as you read the question. What do you need? A working trial balance. So I have the working trial balance sorted out for you already, but I would like to draft it out as we go along once again. So we have to do a working trial balance, which is your assets minus your liability to give you capital once again. All of your debit and all of your credit should balance. You know what a trial balance look like. So we'll be doing that as we go along. So Simon Cook is a producer of natural juice. Natural juice. So once again, we looking at the main things here within this question is that she is a producer of natural juice. So what that tells you that this organization, the natural juice, you have to take out all the clues as you go along. Is this what is your asset? What is your non-current asset? Because student took some of the non-current asset and put it as current asset in their financial statement. So natural juice means to say it's like a little producer, a little manufacturing company, but it's a sole trader. She provided full information for about her assets. Inventory of frozen beverages. So inventory is an asset, right? You have her inventory. 50,000, your asset will have a debit balance in your trial balance. Simon Cook owns an industrial blender. So let's put in the industrial blender. Valued at 200,000. So that is an asset, you put it on the debit side. A delivery van was bought at a total cost of 140,000. So she has a delivery van worth 140,000. However, we didn't finish that question. When she bought it on the 3rd of January, let's make a note of that. 3rd of January. However, using a 6-year 20% per annum loan for 60,000. Now, remember the examiner gave you the information that is necessary. Don't go and try to figure out what is the difference, where the difference come from, what we're going to do with the difference, how to account for it. The examiner say, hey, they probably buy by cash, they probably buy by check, they probably, I don't know. So they have it owing on credit. Let's just not make assumption. She take a loan, which is a 20% per annum. For how much years? For 6 years. So we put in that here, so we don't have to read that over and over. Loan is a liability, so it normally has a credit balance. So we put it on the credit side for 60,000. Tea farmer who promised to supply some apples for the apple nectar blend was paid 9,000 in advance. So you have a payment for advance payment. You make an advance payment for your apple nectars, right? So some people put it as prepaid expenses, but let's put it as an advance payment because the nectar blend, regardless of if it's a prepaid expense or advance payment that you make, both is a current asset. And the reason why I use the word advance payment here is because she's a natural juice producer. So therefore, this will be like an asset. It'll be like a work in progress material that she's using to make the juice and not really an expense to go into expense statement account, right? Income statement. So, however, it's a current asset because it is being owed to her still because she paid for it in advance. So 9,000 is an advance payment. Simon Cooks owns a refrigerator. That refrigerator will be a non-current asset as well, which will have 95,000 on the debit side. Health food store was supplied with products, so therefore she sold some goods to health food store on credit for a value of 10,000. So they are owing her. So that is an account receivable, right? Now let's put the name here so we wouldn't lose track of what we're doing. It's 10,000. Although they state that the company promised to settle with it by March 2018, that means to say they give her 3 months or how many months credit, right? Rent of 20,000 outstanding. Outstanding rent is rent payable, which means you have to accrue for that, right? So you need to accrue for it. Of how much? Rent 20,000. So it's a liability. Ultimate Muscle Builder Limited owes Simone. So another person is owing her. So it's another accounts receivable here. Now you could have put it one time and add it together, but let's leave it as separate. Ultimate Muscle. For how much? 15,000. Right? And Simon Cooks holds 18,000 her bank account and 8,000 cash. So how much you have in bank? 18,000, which is an asset on the debit side, and cash, which is 8,000 on the debit side. Now remember your accounting formula: assets equal liabilities plus capital. So that is how your trial balance work. All of this here is your asset, all of this here is your liabilities plus capital. But we do not have your capital figure, so we'll have to leave that as a balancing figure. So your capital is a balancing figure that you'll be working out when you take all of your assets and you minus your liabilities. In this case, 545 minus say 80,000 give you 465. Now it's simple as that. However, we didn't read the additional information. So you now have a working trial balance within a few minutes of reading the question. And we just have to include now the additional information so that we will have all that we need to construct a statement of financial position. The additional note said interest charged on the loan from Optimum Beverage have not been paid for the month of January. So 1 month has not been paid. So now if that 1 month has to be accrued for, we have to calculate for 1 month for this loan. So loan at 20% per annum means to say you have, let's just work the workings here. Loan is equal to 60,000 multiplied by 20%, 12,000 per annum, and you divide that by 12 to get a 1 month rent that is outstanding. So divide by 12. So the accrued amount for your loan should be 1,000. So we now have to include that in our working trial balance. So loan interest payable, which is accrued for, should go as a liability because it's payable, 1,000. Now remember, this here was your capital balancing figure. So if you include 1,000 on your credit side, you have to minus it from the balancing figure in order for your capital to balance. So let's minus that 1,000. So now your capital change, right? It's a balance figure and your trial balances. Seaman Cook has decided to depreciate the delivery van using the straight line method. So you know what the straight line method is? The depreciation remains same each year, and it's based on your cost and based on the number of years that the asset is going to exit, less its resale value. So the motor delivery van is worth 140,000. And she expects to sell the vehicle for $12,000. So you minus the 12,000 that she's going to sell it for at the end of 8 years. Says 128,000 is going to be depreciated over the 8-year period. So how much will be per year? Depreciation per year will be 128 divided by the 8 years to know how much going to be for each year, right? So that's 16,000 a year. But we only doing it for a month. The vehicle was bought on the 31st of the financial statements for the 31st of January, and it was bought on the 3rd of January. So let's divide it by 12 months to get the depreciation for 1 month. And in that case, it's 1,333 rounding off. Now, depreciation is always on the credit side because it reduces the cost of the assets. So let's include that we have to accrue for the depreciation 1333, account for it, I should say. Now, since it went on the credit side of your trial balance, your balancing figure for your capital has to be adjusted to reflect this. So it once again will have to be minus because it was stated on the credit side. So your capital figure is 460,667. Now, let me tell you how straightforward it is. You know how your financial statement is structured? All you have to do now is take the information from this working trial balance and plug it into your financial statement. Within the few minutes of constructing a working trial balance, you can now take off your non-current asset, which is the industrial blender, delivery van, the refrigerator, less the accumulated depreciation or the 1 month depreciation. In this case, get a net book value of your non-current asset. List down your current asset, which is inventories, your advance payment, your accounts receivable for both people, 10,000 and 15, which is 25,000. Bank and cash. So current asset minus your current liabilities will give you a working capital. And then you minus your loans, which is a non-current liability, to give you your financial statement. Now I already have it drafted out. So let's look at it. So for 20 marks, 36 minutes, in less than that time, we already accomplished where we're going to be with this question. The information is just going to be plugged in under non-current asset, 95,000. And as you tick and you go along, you can identify what is what, right? So your refrigerator, 95. You highlight that what I like to do is to tick, but for some reason my pen is not working, right? Industrial blender, 200,000. So we use that. We include now all the delivery van, right, for 140,000. So where's the delivery van? Here is the delivery van. So you tick that as you go along doing your question. Make sure unless you accumulated depreciation, which is 1,333, get your net book values, and that is your net book value of your non-current asset. Moving on now, you have your current assets. So you start with your inventories. Then you have your advance payment. You have your accounts receivables, your two accounts receivables. So all of this you're going to minus, right? And the reason being, bank and cash, all of this you use and you plug it in. See how easy it is just to plug in your information. So you get all of your current asset. Now you minus your current liabilities, which is your accrued expense, which would be on your credit side. So you have your rent payable, which is accrued for. You have your interest payable, which is the 1,000 that you are your loan interest. All of your current liabilities, you get subtotal minus it from your current asset. You get your net current asset, which is your working capital. One thing left is your loan for 60,000. As you minus all of your assets minus your liability gives you your capital or your net asset, 462,667. What is the balancing figure we have here? 462,667. And your financial statement balance. So it was simple as that. Okay, so once again, when you're approaching a question like this, the first thing you need to do is to look at your requirements. It helps you save time. It gives you an approach for the exam. It allows you to know when you're reading the information, what you need to extract from it for your solution. So let's look at the other question, which is a normal provision question. Adjusting question, I should say. It's June 2017, a 7-mark question, part B, just for the journal entries. Now, what I tell students to do as well in a question like this, when you're doing journals, do a T account. I have a ledger account structured out here for you, but in your working booklet, you all could just simply draw a T. You don't have to put date, details, and amount. All you have to do is just simply draw a T because it's your working. So that it tells you, it gives your brain the information, what goes where and how, so that you would not go wrong when you are constructing your journal entry. So let's look at it. Prepare the entries in the general journal. Once again, as you can see, I am reading the requirements to show how these events affect the income statement. So when you're reading the question, you want to pull out the journal entries that you're going to post, you're posting it to reflect how it affects your income statement. So anything, do not confuse yourself with anything else within those transactions. When you read it, don't try to be complicated. Just simply pull out the information as to what is going to affect your income statement and how to post your journal entry. At the end of the accountancy year or first call transport company, narratives are not even required. So let's look at it. On 31st of March 2017, the accountant of First Call Transport Company discovered three year-end events that requires entries in the general journals as follows. A debtor had paid only 50% of the 33,000 owed to the First Call Transport. The money received and the bad debt incurred had already been entered in the ledger. So they already entered the receipt into the ledger's account. All that you requires now is for you to do your bad debts entry. So if you paid 50%, the other 50% is what needs to be accounted for. So 3,000 multiplied by 50% is 1,500. So you need to open a bad debt account. So this is supposed to be your T account, not a ledger, right? You just open it, draw a T account. One line like this and one line coming down. It's easier for me to teach like this, so it remains neat. But for your working, just draw a T. You know what T looks like, right? You put bad debt to the top. Now, bad debt is an expenses. It's an expense, sorry. So what do you normally do with an expense account? You normally have to record this bad debt, right? So what would have happened? You would have accounted for it by crediting the accounts receivable and debiting your bad debt expense. So you would have accounts receivable here. I'm just writing it in short because remember you're doing this in pencil, right? So you would have credit your accounts receivable and debit your bad debt. How this is going to be related into your income statement? It has to be written off to your income statement at the end of the financial year. Remember, bad debt expense does not have a balance carry forward. So on the credit side, you would have put income statement showing that you wrote it off straight to the income statement. So you credit your bad debt expense account. So therefore, income statement needs to be debited. So in your journal entry, you will debit your income statement for 1,500 and you would have credited your bad debt expense account for 1,500. Now remember your indentation. Your credit entry must be indented in your journal entry, okay? The debit one is normally written first, the credit one is indented. And as you can see, when you subtotal both sides of your account, it will be balancing. And normally, what we used to do is cross two lines across it, say there's nothing more to do with the account is totally written off. And that's it for the first part. The company is to provide for bad debts at a rate of 2% of your accounts receivable. Once again, all they're asking you here to do a provision. So the provision on the receivable is a first time a provision, so you don't even have to think about it. The depreciation provision is increasing or decreasing, whether it's going to be a debit entry or credit entry, you don't have to even bring in a balance from before. But also remember that provision for depreciation acts like a accumulated depreciation account for like normal non-current asset. I tell students when they do this, think about provision for bad debts, sorry. Think for provision of bad debts just as you would do a depreciation account. A depreciation account does not directly reduce your age receivable, but it has a balance that is continuously there. That when you are doing your financial statement, you will minus it from the accounts receivable account. So unlike the bad debt that is written off totally from your accounts receivable account, this, however, stands alone and it's reduced in your financial statement, reflecting a reduced value each year. Right? So we have to open a provision for doubtful debts. And as the word says, it's doubtful or provision for bad debts. So a provision for bad debts, remember your accumulated depreciation account, how that acts again? When you actually posting this, you will normally credit your accumulated depreciation account and you will debit your income statement. It's the same thing for a provision for doubtful debts. Once you are now posting the entry, when there is an increase or decrease, that is only time you have to question yourself whether it's going on the debit or credit side. In this case, as a first timer, all you have to do is write it off the income statement here at once. But what did we calculate what we write it off? No, we're writing off 2% of the 43,600. So 43,600 multiplied by the 2% is 872. So the 872 goes directly to your income statement. At the end of the year, what you would normally do, you'll have a balance carried down for the value, and you will have a balance brought down for that value at the beginning of the next period. Now, you don't have to do all this in the exam. I am just showing you this so that you will know how it really works, right? So the income statement, here you see you credit your provision for bad debts. So therefore, you would have debit your income statement. So once again, in your journal entry, you would debit your income statement for 872, and you will credit with your indentation provision for doubtful debts or provision for bad debts, 872. Remember, no narrations is required. Now, this next transaction is just requires you to think a little bit or do some more calculations as the case may be. They say the company had paid a sum of 18,000 to the landlord to cover rent. So you're paying for rent, but they pay for rent for a year and a half. A year is 12 months, a year and a half will be 12 plus 6, which will be 18 months. So if you paid 18,000 for 18 months, right? It's basic maths, 18,000 divided by the 18 months will give you how much is for per month, right? And now we want to know how much for the year. This is what's supposed to be reflected in your income statement. You cannot account for prepayments in your income statement. You have to reduce the value to reflect what is the expense for that financial year. So in this case, for 12 months, it could just be simply be 12 multiplied by the monthly payment, which is 12,000. Now let's see what would have been in our general ledger. In our ledger account, we would have rent expenses. And when the owner paid for this rent, they would have credited their bank or credit their cash account. So cash or bank would have been credited, but your expense account would have been debited, right? So they would have debited with the 18,000. Now in this case, how much is supposed to go to your income statement? You have to write off to your income statement 12,000 because that is what's supposed to go for the year. What happens to the difference? The difference goes into your financial statement as prepaid rent. Now, some lecturers may tell you use balance carried on. Some may say use prepaid rent. The correct method based on accounting reporting should be thought from this stage. It should be just to put in your prepaid value because an expense account does not have a balance carry forward or brought forward. An expense account is written off for the financial year that it incurs. So what happens is supposed to create a prepaid rent account by crediting your rent expense and opening a prepaid rent that will act as a current liability. Well, prepayment is current asset in your financial statement. So here supposed to have 6,000. Then it would have been balanced. Now, this is not required for you in the exam. I am just putting this part. What you're supposed to focus on is what happens to your income statement. That is what the examiner telling you. But I did this so that you will see what is going on. So what happened to the income statement? Once again, your rent account is credited. So therefore, your income account will be debited. So you have your income statement will be debited for 12,000. And your rent account with your indented figure should be credited for 12,000, which will show you your double entry. Rent was credited for 12,000 here, and your income statement would have been the other account that is being debited. And that would have given you your full 7 marks. So, once again, thank you all for joining me on our first day. I hope you see the significance and the importance and how critical it is for you to understand financial statements, the formats, and adjusting entries, how it affects your financial statement. The examiners can bring it from any type of questions. Once it's a financial statement, sole traders, partnership, limited liability, any type of question they can bring this, or even part of another question as they did in June 2017. Now let me just show you what they did in June 2025. In June 2025, they bring an entire question on limited liability, right? Presented this whole question. There is auditors' fees to accrue, so they have accruals, they have prepayments, and they have depreciation listed in it for adjusting entries, just as we look at today. However, this one question had 40 marks. It was an income statement for 11, appropriation for 9, and a statement of financial position for 20 marks. Now, students have to remember accruals and prepayments. What you put in your income statement for accruals and prepayments must also be placed in your statement of financial position. If you forget that, you may you not may, you will lose marks if you forget or you omit it from any one of these statements. And of course, you will not balance. So, thank you once again. Join me for day 2. I will post up when that day is. It should be most likely, if not during the week, it will be next Sunday at the same time. Have a blessed one and all the best in your exam.